This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. We're going to work through question 1 of the December 2010 paper F9 exam. So make sure you've got the question in front of you. And always go straight to the requirements. So if we look at the requirements, part A for 12 marks, calculate the net present value of project A and advise on its acceptability if the project were to be appraised using this method. Part B, 7 marks, critically discuss the director's views on investment appraisal. And C, 6 marks, calculate a project-specific cost of equity for project B, explain the stages of your calculation. So let's have a go. First of all, part A, calculate the net present value of project A. So if we look at the body of the question, CJ Company is a profitable company, financed by equity, market value of 180 million, by debt, market value of 45 million, 2 investment projects. Well, for the moment, I'm only concerned with project A. It's the expansion of existing business. It's costing 3.5 million, payable at the start of the project. It'll increase annual sales by 750,000 units. Information on unit selling prices and costs as follows. So they've given us the selling price, the costs, they're in current price terms, and below there's information about inflation. We'll also need working capital. But the one thing it doesn't say, which of course is desperately important, is how many years the project's going on. Well, I'll ignore project B completely for the moment, but other information. With a nominal weighted average cost of capital of 10%, they pay tax, a year in arrears at 30%, their capital allowance is 25% reducing balance. Risk-free rate, equity risk premium, general rate of inflation. I still don't know how long the project's lasting. What about directors' views on investment appraisal? All investment projects should be evaluated using either payback period or return on capital employed. Target payback period 2 years, target return on capital employed 20%. Project is accepted if it satisfies either one of these criteria. Here we are. The directors also require all investment projects to be evaluated over a 4-year planning period, ignoring any scrap value or working capital recovery, with a balancing allowance, if any, being claimed at the end of the 4th year of operation. Well, now we can get into it. Remember, it's only project A I'm looking at. It says it's going to be evaluated over a 4-year period. So I'll set up my years 0, 1, 2, 3, 4. And let's get straight into it. It'll cost 2.5 million. Let's look first of all, though, at the operating flows. And we've got 3 mentioned. Selling price, selling costs, variable costs. Well, let's get them down. First of all, the sales revenue. It's 750,000 units. Now, I'm going to work in thousands, as I usually would in the exam. 750 units, selling price $2 a unit. So 750. $2, but it's in current price terms. If its current prices are flowing 1 year's time, we'll have a year's inflation, 2 years' time, 2 years' inflation, and so on. Well, the selling price inflation is 5%, so we'll multiply by 1.05 to inflate. So the flow at time 1, 750, $2, 1.05. I get 1575. Well, I'm not going to show workings for all of them, and don't in the exam, it's wasting time. But since it's 5% each year, multiply by 1.05. So at this time 2, it's 1654 to the nearest 1,000. Another 1.05 is 1736. Another 1.05, 1823. At the costs, well, the selling costs, same idea. So in the first year, 750,000. It's 0.04 per unit, which comes to 30. But because that's at current prices again, inflate, selling cost inflation, 5%, so multiply by 1.05. I'm keeping to the nearest thousand, I get 32. Another 1.05 takes me to 33. At time 3, 35. And at time 4, 36. Finally, variable costs. Here, well, I would actually show workings to the first, just in case I've misread something, at least I can get credit for approach. 750 units, 80 cents a unit. It's at current prices, but inflation here is 4%, so 1.04. And the time 1 flow, therefore, sorry, start again, 750, 80 cents, 1.04, 624, and multiply by 1.04 each year, so 649, 675, sorry, my calculator went wrong there. Hold on a minute. Uh, 702. And so the net operating flows at time 1, I get 919 at time 2, 972 at time 3, 1026, and finally at time 4, 1085. Now I'll turn to tax. You should be aware there are two ways you could deal with tax, but I think by far the easiest, the safest, the quickest is first of all to calculate the tax on the operating flows. So for the moment, ignore any capital allowances. And what was the tax rate? I saw it somewhere. Yes, under other information, tax is 30%. And it's 1 year in arrears. So time 1919, 30%. The tax is 276. 1 year later, so at time 2, I'm sorry. Time 2, 972 times 0.3 is 292. 1026, 30% is 308. And finally, year 4 we had 1085, 30%. There'll be 326 payable 1 year later at time 5. Now let's look at the capital flows. So the original cost was 3.5 million, so 3,500 times 0. And it did say, I remember when we looked at directors' views and investment appraisal, the last paragraph, it said ignore any scrap value. Now we can do the other bit of the tax saving on the capital allowances. And here, let me jump to workings. It's 25% reducing balance. So the original cost, 3,500. The first capital allowance, it's 25%. Which is 875. Gives a reducing balance of 2625. Remember, we're after the tax saving. And so with the tax rate at 30%, the tax saving is 263. The second allowance, 2625. 25% is 656. The reducing balance becomes 1969. And at 30%, the saving, 197. And on we go, the third allowance, 1969. 25% is 492. We go down to 1477. The tax saving, 148. Now, a little bit strange here. It does say a balancing allowance at the end of the fourth year, and yet it said to ignore any scrap. Well, whatever. At the end of the fourth year, therefore, always we simply subtract the sale proceeds. Here we're ignoring scraps of 0. Whatever's left is the balancing allowance. And so it's 1477, and at 30%, it comes to 443. So let me finish off the schedule here. The tax savings, first year, but 1 year later, so at time 2, 263, 197, 148, and 443. All that's left is the working capital. It says additional working capital of 250 will be needed. Well, we'll assume, it doesn't say any different, we'll assume it's needed immediately. So 250 at time 0. It's expected to increase in line with general inflation. Well, general inflation, if you look under other information, the general rate of inflation is 4.5%. And so we had 250 at the beginning. Well, we need an extra 4.5% at 1 year later at time 1. And so 4.5% of 250, extra working capital of, again, I'm keeping to the nearest thousand, I said at the beginning, so an extra 11. But watch for this, he's done this a few times. It now means we've total working capital of 261, 250 plus 11. So at time 2, again, there's 4.5% inflation, so we'll need an extra 4.5% of the total of 261, which is 12. Now, I'm not going to keep showing workings, and I wouldn't in the exam. You know, I've done enough there to prove to the marker I know what I'm trying to do. So if I do make an arithmetic mistake, it's only half a mark. I don't want to waste too much time. But anyway, let's do it. The working capital I've now got, 250 plus 11 plus 12 is 273. 4.5% of that is another 12. How much now? 250 plus 11 plus 12 plus 12. I have 285. 4.5% of that is 13. Excuse me. Now, again, unusual. Normally, in the fourth year, we'd expect to get back all the working capital. But it specifically said here, that last, very last paragraph before requirements, ignore any scrap value or working capital recovery. So we're almost there. What's the net cash flow each year? 3,750 outflow at time 0. At time 1, 908. At time 2, I think 947. And sorry, I don't know why I put that one in brackets, 908. At time 3, $919. At time 4, $912. And finally at time 5, $117. We need to discount. Under other information, it says with a nominal weighted average cost of capital of 10%. Well, remember, the nominal rate is the actual cost of capital. That's the rate you apply to the actual cash flows. So here, we've got the actual cash flows we've been inflating. We'll discount at the actual or nominal cost of capital at 10%. So the discount factors, 0.909. Where are my tables? Here we are. 0.826, 751, 683, and 621, giving present values. Sorry, I pressed my buttons too fast. 825, 782, 690, 623, and finally 73. The net present value is negative. It's 757. I will put 1,000 because remember I've done the whole thing in thousands. No, I won't because it's rounding. It's 757. Okay, I'll put K for 1,000. Look back A, calculate the net present value. Well, we've done that. It says advise on the acceptability if it were to be appraised on this method. Well, quite simply, net present value is negative, and therefore we should reject the project. Actually, although here I think that's probably sufficient, for the time it takes, I always add one little bit, which certainly at times could get you an extra half mark or so. We should reject the project subject to the accuracy of our estimates. It's actually more relevant when we get positive NPVs and we're accepting. But clearly, all the cash flows would have been estimates, the cost of capital estimate. However, there's part A, 12 marks. We're well on the way to getting the pass marks. What about part B? Critically discuss, so no arithmetic here, the director's views on investment appraisal. Well, we can ignore all the rest of it. There's one paragraph headed up, Directors' Reviews. So let's make a few points. The directors require that all investment projects should be evaluated using either payback period or return on capital employed. Well, why just those two? Why do they not consider the net present value? Now, I'm not going to write an essay here about why net present value might be better. Appreciate it's only 7 marks, and there are quite a few points we can make here. But certainly there's one critical point to make, or one point to criticise. Payback return on capital employed may have relevance, but certainly they should have looked at net present value. Let's carry on though. Payback period. Target payback period is 2 years. Why a target payback period of 2 years? It seems rather short, to be honest, but there could be reasons for it. I'm not going to work out the payback period. It doesn't ask for it. But here, nothing like pays for itself in 2 years. But where did it come from? Return on capital employed, a target of 20%. I can see that. That's the current return on capital employed, so there is sense there. A project is accepted if it satisfies either. Why either of the two? What I mean by that, all right, maybe they look at payback, maybe they look at return on capital, but why not both? A company will look at a range of measures, and it won't just be, does it satisfy one of them? They'll normally want it to satisfy all their criteria. Carry on, though. They're going to be evaluated over a 4-year planning period. Why 4 years? I mean, there may be reasons for it, but the way it's presented is though they've just come up with these rules, not given any justification at all. What about scrap? Why are we ignoring scrap? I mean, maybe it is 0, but just simply to ignore it. I mean, the project costs, what is it? 3.5 million. I would normally expect that after just 4 years, there'd be a worth to it. And of course, that could make a substantial difference to the net present value we ended up with. And I think finally, the last thing I'd mention certainly is working capital. Ignore any working capital recovery. I mentioned at the time, when we were setting up the cash flows, when we were setting up the cash flows, I mentioned that usually at the end of the project at time 4, you'd assume all the working capital came back. And we've invested 250, 261, 273, 284, no, 285. Again, if we got 285 back at time 4, I can see the NPV would still be negative, but it'd be much less negative. But it'd start bringing in scrap proceeds, and maybe the project would have been worthwhile. Anyway, although I'm writing it as short notes, if I had time in the exam, I'd perhaps write slightly more. But that certainly would get me most of the 7 marks. Part C. This is an important bit and very much a learning bit. Calculate a project-specific cost of equity for Project B. Project B. Look back at the body of it. This project is a diversification into a new business area that will cost 4 million. A company that already operates in the new business area, GZ, has an equity beta of 1.5. Well, the first thing is we need to know the risk of the project. Now, it says explain the stages of our calculation, so I will as we go through. The first thing we need to do is find the beta of the project. Well, to see how risky the project is, we found a similar company. The beta of its equity is 1.5, but it's a geared company. The gearing will have made the share more risky, so the 1.5, part of the reason for that level of beta is the gearing. So we need to take out the gearing. We want the asset beta, or beta A. And we've got the formula on the formula sheet that the asset beta, VE over VE plus VD, 1 minus T, beta E. And the gearing we need, excuse me again, we need the gearing of GZ. Take out the gearing in GZ. And so the gearing equity 75%, debt 25%. I'm sorry, there's my first little error. He tried to trick us. For this formula, it's the market values of the two that we're after. So presumably the 75-25 are book values. That's irrelevant. The market value of the equity is 90 million. The debt is 30. So it's now just calculator. Beta A, equity 90 over 90 plus debt 30 times tax rate was 30%, so 1 minus 2.7 times 1.5. So the asset beta is 1.22 if I keep to 2 decimal places. Well, that's the risk of this similar company business, and therefore there's the risk of the project. However, to get a project-specific cost of equity, I need to know the risk of the equity that's being used in the project. Now, unless you're told different, we always make one assumption. We will assume the project is being financed in the same gearing ratio as our company. And the company I'm talking about is CJ. That's the company that's doing the investing. We'll assume it's financed in the same way, and therefore the equity that's being used, because of gearing, it's more risky, it would have a higher beta. So we'll calculate beta for the equity. And so we're going to use the same formula again. But we're gearing the project in the same way as CJ, so it's CJ's gearing that we're concerned with. CJ's gearing was the first paragraph of the question. The equity has a market value of 180. The debt has a market value of 45. So we'll use the formula backwards. The asset beta, the beta of the project, is 1.22. It's equal to 180 over 180 plus 45 times 0.7 beta E. And so beta E is I think 1.43. And so that's the beta of the equity that's used for the project, and therefore the cost of equity for the project, or the project-specific cost of equity. is calculated from this equity beta. And we'll use the normal capital asset formula. It's the risk-free rate plus beta times the market premium. Under the other information, the risk-free rate is 4%. The beta of the equity is 1.43. The market's premium, or the equity risk premium, is 6%, which gives us a project-specific cost of equity, which is what we're actually asked for. Of 12.58%. And there we are. I hope that's helped.